How's it going, everyone? So in today's video, we're going to talk about trading options and how to properly use a stop loss. And when I say properly, that's just the way that I do it, right? So everybody has their own unique way of trading. The way that I use the stop loss is the one that works best for me. And I'm going to go over some points on exactly how I do that. So first, I'm going to go over how I do it, how I use a stop when it comes to trading options, some other methods that a lot of other people use. And then the best thing is I'm going to go over a real trade example showing exactly how I use it, getting out of a trade quick when it does not go in my favor, so that way I can keep the losses small. So now let's get into how I do it. So first off, a lot of people ask me this question. I do not use a hard stop. I don't type a price into the system. My stop is the sell button. So I'm just using a mouse and I'm clicking sell when it does not go in my favor quickly. I know that some people think it's risky to not use a hard stop, but at the end of the day, I just want to make sure that I trust myself to click sell when the trade is not going in my favor. Now remember, I'm far from perfect. There are times where I give trades a few more minutes, the loss is bigger than it needs to be, but at the end of the day, I'm always getting out of the trade. I'm never holding that trade for hours or ever turning it into a swing trade. Worst case scenario is I give it a few more minutes than I need to, but I'm always going to just get out of it and I'm flat at the end of the day. Now, that doesn't mean that using a hard stop is a bad thing or doesn't work. It just doesn't work best for me. I trust myself that I'm going to click the mouse and get out of that trade when I need to. So that's why I do it. Okay, now to go a little bit deeper as far as the stop loss. So what I'm doing is I'm taking the trade based on a technical pattern or a technical level. The patterns that I like to trade are opening range breaks to the upside, the downside, and then bull flags and bear flags. And the technical levels that I like to use are pre-market high, pre-market low, prior day high, and prior day low. It's hard to be perfect, but I like to couple those patterns with those levels because after 5 years of staring at these screens, I've noticed that when that happens, it seems to be a high probability setup. And when I see that pattern develop, whether it be an opening range break or some sort of flag, I want to take the break of the high of the flag if it's a bull flag, the break of the low of it if it's a bear flag, the high of the consolidation if it's an opening range break to the upside, and then the low of the consolidation if it's an opening range break to the downside. And I want to see it go very quickly or I need to just get out of the trade because those are very key levels, also coupled with the major technical levels that I talked about before. Pre-market high, pre-market low, prior day high, and prior day low. So I think there is a lot of factors in place, and if it does not go fast, that could possibly be a fake out, and I don't want to get caught in that. And as far as the amount of time that I usually stay in a trade to give it some time to work, if it doesn't go in my favor in 2 to 4 minutes, that's usually my average hold time. So if I'm in a trade for 2 minutes at a time, if it hasn't gone my favor in that amount of time, I know that I need to just get out. So 2 to 4 minutes I have found is the sweet spot. But here's another aspect of that. So sometimes when we go long or short, things can turn very quickly. It doesn't happen all the time, but it's the stock market. It's hard to predict what anything is going to do. And every now and then, sometimes I go for a breakout and it reverses aggressively immediately. And when it does that, I need to get out of the trade. So that 2 to 4 minutes really is when it's consolidating. Maybe it hasn't gone against me, but it hasn't really gone in my favor yet. I'll give it a minute. I don't want to be too patient. When it starts to pull back, that's when I'm going to get out. But if I go long on a breakout and then it very quickly reverses, rejects that level aggressively, and I'm immediately down on my position, I need to get out of that because that could turn into something really bad. So that's my way of going about it. It doesn't mean that's the best way for everybody, but there are some other methods that I know a lot of other people use when it comes to stop losses and trading options. And the first one is going to be breaks of minor support or resistance, such as bull flags or bear flags. So let's say the bull flag is formed and you want to go long at the high of that flag. Some people will risk off the low. So versus a time, it either breaks that low or they never get out of the trade. And then vice versa, the bear flag. So they take the break of the low of the flag and then they give it to the high. So it either gets there or they just don't get out of the trade. Also, another way of using a stop loss is a close below the 9 EMA, so short-term moving average. They give it a chance to find trend, whether it be to the upside or the downside, and then they use a close in the opposite direction above or below the 9, and that's when they get out of the trade. And another way is some people use a certain dollar amount. I don't like doing this, but I know it works for others. Maybe they want to risk 100 on a trade, 250 on a trade, or 500. So they have their P&L up, and when they're in the trade and they get to that negative number, that's when they take the stop. And then another way is a certain percentage amount. So you put whatever amount is in the trade, and then maybe you only want to risk 10%, 15%, or 20%. So obviously you'd want to be able to see that while in the trade. And then when it gets to that percentage, they take the stop. So these are some of the ways in which stop losses can be used when it comes to trading options. There is no right or wrong way. It really is just trial and error to figure out what works best for you. And with all that being said, now I want to go over a real trade example because the visual is the best way to see it. I'm going to go over a trade that I took on Nvidia on Tuesday, March 8th. I ended up taking a short on it. It did not go quick. Once it started to go against me, I just got out of the way. Had I held it, that would have been a big loss. So now let's take a look at my newsletter watch list and what I was watching for the day. I was looking at Tesla, Nvidia, Facebook, and DKS. And to the left, this is my private Twitter. So if you didn't already know, this is what I post on there 30 minutes prior to open each day. I post a little overview of the SPY and the Qs, so the market in general, and then the individual names that I'm watching, all the levels that I think are in play. And then I do some mental notes on the day, just kind of what I'm thinking about going into that day. And then I make sure to take a picture of the charts, green line to the upside being long, red line to the downside being short. And then I make sure to highlight those levels above. If you're interested in getting access to this, there's going to be a link in the description below. Now let's quickly go over what I mentioned on Nvidia, because this is going to be important for the actual trade recap. So I said not a good candle yesterday, a lot of resistance above now. If it clears pre-market high, it has room to 218, 221. 210 is major daily support. So below 210 and it breaks pre-market low, I felt like it had room to 200, 195 support. So now let's get into the actual trade. So Nvidia pulled back a bit off the open, had a very aggressive buying candle, and then very quickly gives all of that back. So as it comes towards the lows and that 210 level, I end up going short. I took the 210 puts, 10 of them, and I got filled at $6.89. I did get a quick move in my favor, but as you can see, it's kind of hanging around that 209.50. I really wanted to see this break 210, get below it, and then continue to stay below it. When it gets back above 210, it did not stay below it. So I want to get out of the trade just in case if it reverses aggressively. I don't want to take a big loss. And I end up selling those contracts at $6.82 for a very small loss. So I know it's not easy to do, but this is kind of my go quick or get out mentality. 210 was that major level, not only from the daily, but also low of day. So when that breaks, I want to see that stay below it. If it does not, I need to just get out of the trade. And that's exactly what I did. And I'm glad that I did because the loss was small. This actually had a very aggressive bounce. Had I held it, it would have been a huge loss. And now to check out the P&L on that trade. So I took 10 contracts, which is a decent amount of size. It did not go in my favor quickly. So I got out of it and I only lost $61. In my opinion, I think I did a really good job at managing risk and getting out quick. So that way it was only a very small loss at the end of the day. So that was my opinion on how to properly use stop losses. That's just the way that works best for me. There are a lot of ways to do it. At the end of the day, trial and error is going to be the best way to figure out what works best for you. Appreciate you watching the video. Feel free to like and subscribe, and I'll see you in the next one. Thanks for sticking around to the end of the video. I just wanted to highlight a couple cool things I have to offer. The first is going to be my newsletter watch list. This is going to be what I post on my private Twitter 30 minutes before market open every day. And what I'm doing is I'm doing a very quick highlight of the SPY, the Qs, the bigger picture, the upside level that I'm looking at, the downside level that I'm looking at, the market news or the catalyst that day. And then I'm going to list 4 to 6 names that I'm watching, my favorites that day, and then the catalyst behind them, if there's any news, the bigger picture idea, what's going on the daily chart, and then the levels to the upside and the downside. And then I add some mental notes at the bottom, kind of what I'm thinking that day, make sure to keep my expectations in check and follow my process. And the second thing is going to be a one-on-one call. So if you want something that's less of a commitment and you just want to talk to me about my process and how I approach the market, this is going to be great. It's a one-on-one live call for 1 hour. So if you're interested in any one of these 2 things, there will be links in the description below. Feel free to check them out.